Hello, my name is Afsaneh Beschloss. I'm CEO and founder of RockCreek. I'm incredibly lucky today to be joined by some of the most thoughtful investors and thought leaders, including Caroline Atkinson, who is an advisory board member of RockCreek, but also senior strategist to RockCreek, and who was most recently head of global policy at Google, and also worked as deputy assistant to the president and also national security advisor for international economics. Caroline and John Lipsky also happen to have worked at the IMF together for a long time during long periods of crisis. So they certainly have lived through a lot of crisis. John Lipsky is, also we're very fortunate, is an advisory board member of RockCreek. He's Peterson Distinguished Scholar at the Kissinger Center for Global Affairs at the Johns Hopkins SAIS and also Senior Fellow at SAIS Foreign Policy Institute. He was first deputy managing director of the IMF, and also actually ran the IMF for some time himself. He was vice chair of JP Morgan's investment bank and chief economist and director of research at Chase Manhattan. He also, while at the IMF, managed its exchange rate surveillance. So a lot of the work that John has done is incredibly interesting to the conversation today. We're also very, very fortunate to be joined by Lee Kruter, who's partner and head of performing credit at GoldenTree Asset Management. Lee is lead portfolio manager for private credit strategy, a very fast-growing strategy, and very eager to also hear from him on what he's seeing in the markets. But I'm just going to go to Caroline to open with some of the broader context for the economic and financial questions that we are facing, Caroline, acknowledging the extraordinary and the very unusual nature of what's happening in the US that both goes beyond market reactions, and if you could help us explain them in terms of shifts in geopolitics, challenges to a large number of institutions and the crackdowns on many groups, internal and external. But if you could sort of give us a little bit of that background, would very much appreciate it.
Yes, well, I think that, of course, we're going to talk about investments and tariffs and market reactions, but I think it's so important to see those market reactions in the context, not just of the announcements that took place on April 2nd on tariffs and the changes since then, including notably on April the 9th, but what has happened in the weeks before then and continued. That has a really huge impact, especially outside the United States, but I think has a big impact on the investment attractiveness and on confidence in the United States. And of course, early on, from Europe's point of view, there was the questioning on geopolitics of America's support for traditional allies, support for Ukraine, what was the position with Russia. And then we've seen the challenges to universities, the challenges to law firms, many of whom have said, okay, we'll go along with agreeing with an executive order that promises to give some pro bono work for conservative causes, but we just don't want to lose our access to the federal government. Others have said this is a matter of principle and we need to fight it. We have more than 170, I think, lawsuits now against the US government. And just in the last couple of days, it would appear that the White House is considering not carrying out a Supreme Court order about bringing back a person from Maryland who was wrongly sent to a prison in El Salvador, wrongly under the administration's own views. So those changes have really shocked the rest of the world, and particularly our allies. And I talk a lot, as many of you perhaps do, to people in Europe, people in Canada, people in Japan. We see visitor applications to the United States down. We see applications to universities down. We see other dramatic indications of concerns. The Europeans are issuing their staff with burner phones if they come to the US because they're worried about espionage. So all of that context, then the tariffs were announced. That leads to the question about what is this sentiment shift that occurred most dramatically in the markets after April the 2nd. Is it reversible? and how can we contain its impact? We being people who want the US economy to grow and prosper. And most importantly, is the role of the US as the anchor of the global financial system challenged? What does that mean for bond markets? What does that mean for the dollar? Even in the global financial crisis, when John and I were working together from the IMF, and everybody remembers that, the crisis erupted in the US, but people came to the US to keep their money safe. That's not been happening so much now. So how do we turn that around? And then lastly, I think it's important to wonder, what's the Fed going to do? How can it cope with the normal market disruptions? So those are just some of the sort of context. It's really hard to overstate how stunned our allies outside the United States and potential investors are. And of course, there's uncertainty arising from all of that. I don't know if, John, you would like to comment on that, or on what global market reactions are telling us about other countries and how they are.
Well, Caroline, I'd add just two quick points to what you've said. One, let me take it one step further back. Last fall, the topic when you were talking about the U.S. would have been the U.S. exceptionalism. How is it that the U.S. economy is performing so much better? How is it that the outlook for the U.S. economy's future growth and performance seems so much better than anywhere else? It crystallized, I guess. I love the quote from Carl Bildt, former Swedish prime minister, who said that China is the superpower of production. The United States is the superpower of innovation, and the European Union is the superpower of regulation. And so there was this view of US exceptionalism in a favorable way, and how that has evaporated so suddenly and so comprehensively in the way that you say, that the uncertainty about policy has, I think we don't talk so much about is the U.S. Productivity gains going to continue to accelerate. We all think protection is going to, if it happens, is going to interrupt things. The second point I would make is the seeming incoherence of the U.S., the authorities' expression of the goals of their policies. I won't get into the business with the universities, with the law firms and all this, which is, of course, astonishingly unexpected and shocking. But rather, you've had the Secretary of the Treasury say that the goal of our external policy is to escalate protection with the goal of de-escalating. Namely, the goal is actually to lower trade barriers everywhere. You've had Mr. Navarro, I don't know what his tie, I guess he's an advisor to the president, say that the goal is to produce $6 trillion of revenue from tariffs in the next 10 years. And you've had the president and others say, no, the goal is to reindustrialize and return manufacturing to the US. And you say, well, wait, if we're not importing because we're producing here, we're not going to produce the tariff revenues. So even in this most basic area, it's very hard to understand exactly where they're headed and what assumptions we should make. So obviously the theme of the moment is very profound uncertainty about where things are going. And let me just add two more little points. Maybe they're not so little. One, of course, is that this talk on trade has all focused on trade on goods and not trade on services, where the U.S. is running a surplus, and especially with regard to Europe, is running a surplus about as large as the Europeans' trade surplus in goods trades with the U.S. So this an area that looks like an area of the future remains completely undiscussed. And one would assume if we're worried about retaliation, if we're putting tariffs on the area where we think foreign producers are succeeding, i.e. goods, what will happen if the response of retaliation is to retaliate in goods and services where the U.S. is succeeding. And then finally, the reciprocal trade tariffs that were discussed. The word reciprocal is used in a completely ununderstandable way. The simple idea is we'll do to you what you do to us. But that's not what they have proposed. But in any case, regardless, whatever you call it, it is not compliant with the most favored nation treatment that is basic to the World Trade Organization. So quietly, without talking about it, we are proposing to completely upend one of the bedrocks of the international system and trade that the United States had a fundamental role in creating. Well, I'm sure there's plenty more to talk about, but that's my first salvo.
Oh, Afsaneh, we can't hear you.
John, if you could also comment on the role of the US dollar as an anchor of the global financial system. How do you feel about that? Do you feel, Caroline mentioned, do you feel it has been weaker in the last number of months, but particularly the last couple of weeks, it's been up and down. Maybe it's having a good day today. But do you feel it's going to settle down, or is that something we should be watching?
Well, we should be watching because, again, as Caroline pointed out, and back in the global financial crisis, there were two things to say about that. One, everyone recognized that the U.S. financial system and the flaws in the U.S. financial system were the primary cause of the global financial crisis. At least it was the epicenter, and yet there was no doubt when doubts were created, or when the challenges were created, the international financial system, private actors came to the U.S. dollar, came to the U.S. system, and that's not happening now. Secondly, even though there was a sense that the U.S. was the epicenter of the problem, there was a very clear sense, and I felt it very deeply. If you remember, the G20 leaders process was created instantaneously in November 2008 in response, in the wake of the Lehman collapse and the market turmoil. It wasn't that countries forgot about their own self-interest, but there was a very clear sense at the leaders level that we're all in this together, and if we don't work together, we stand at great risk. So there was no sense of great power conflict in trying to work out how do we solve this problem. Today, what you sense is there's a lot of talk about have foreigners lost confidence in the U.S. system. I would say I've never seen the U.S. financial system move fundamentally in a direction that was dominated only by external events and external views, and not in concert with domestic investors' views. But I think the point is both foreigners and domestic investors are wondering what's going on here, and are beginning to clearly to worry that the fundamentals in the U.S. Are going to end up deteriorating relative to elsewhere. Hence, rise in treasury yields, weakening of the dollar doesn't strike me as either so surprising, but it is worrisome.
Lee, you think about spreads, and you think about credit, and you think about currency, and you think about tariffs, obviously through a set of lenses. Would be great to hear your perspective and how you're seeing markets change.
Yeah, so maybe I'll start out with I guess it's all somewhat what expectations are to begin with as well. So when we came into the year, and our CIO and founder Steve Tannenbaum, he was at Davos earlier this year, and I think the theme at Davos was, as John was saying, was about U.S. exceptionalism. And I think if you look back the last 10 years at Davos, whatever the theme is, you're supposed to actually do the exact opposite of whatever the theme is. So we came into this year actually, I'd say, post the excitement in markets, following the election in November, we had the view that this was actually be a somewhat more challenging year in markets. We didn't understand how that was going to happen or why that was going to happen, but we had that view, and we looked at it very similar to really what happened when Reagan came in, because that first year when Reagan came in, there was a lot of excitement about, growth and deregulation. And you actually had, I think the S&P was down 10% that year specifically. So I guess fast forward and, maybe to throw a bit of cold water, we're just 7 days into this. I know that things that Caroline has mentioned, some of them have been going on for a couple months at this point in time, but it's very heartening to see, VIX has come down a lot here in the last couple of days. VIX is back under 20 at this point in time. So when we look at spreads today and we look at markets, certainly we're seeing a lot of incongruous things. Obviously rates higher with the assumption, now that growth is getting materially worse from this sense. Probably the most day-to-day on the investing side, the most worrying thing for us is more what we hear from our companies than anything else. I think there's probably more confusion amongst companies about what to do. We do a lot in the pharmaceutical space, and I think one of, theoretically their goals is to bring pharmaceutical, manufacturing back to the US. It takes hundreds of millions of dollars and 5+ years to get FDA approval to bring a manufacturing plant back to the US from that sense. So I think companies are probably struggling as much. And I think to your point, what we're most worried about in the very short term is what is that economic impact in the very near term, which things seem to have really come to a bit of a halt here, forgetting about the outside travel from that sense. So we did see spreads and, whether it's investment grade spreads, high yield spreads, they did widen out a lot. They're definitely not pricing in a recession at this point in time. So I guess purely from a day-to-day perspective, we're looking for, I'd say, what, maybe not a solution to all this, but what is the roadmap in the very short term? And I'd say now that it feels like Bessent has taken a lead role in negotiations, and we think it was very important, and given some of the conversations about rates as well, so too, that Japan is the first one that they're really focusing on to get a trade deal done, and Japan being the largest buyer of US Treasuries, I think 40% as the largest external buyer is Treasuries. Really everything Trump's trying to solve, whether it's on the tax side, the deficit side, really needs lower rates in the short to medium term. So I think we're a little bit less focused on spreads today and just where's the economy going, and then what can they do and how can they push rates lower. And I know we'll talk about what the Fed's going to do a little bit, but certainly whether it's on the equity side, on the regular credit side, with the stabilization, we're not pricing in any sort of recession. So we have added a little bit of risk here, but I'd say we're still in sort of the, not bearish, not bullish, sort of in this wait and see mode at this point in time. This is how I'd kind of frame it.
And Lee, how do you see, it's very interesting, how do you see the interplay between the tariff dynamics, the uncertainty that I think we've all spoken about, which can lead to nothing much happening in the real economy, consumers pulling back, businesses pulling back investment, and then the prospects beyond that for US growth? Because I think that my sense is that the views about whether or not there will be a recession are pretty evenly balanced. There are some more bearish, but there are others who, especially in the experience of the last few years, has been that many of us and many economists have called, oh, there's going to be a recession, and it didn't come.
Yeah. So I think it's interesting. I was having a discussion about this morning. Unfortunately, we've all turned into gerbils right now, and our memories are extremely short. I was at breakfast with somebody from Los Angeles this morning, and we were talking about how nobody outside of Los Angeles talks about the fires in Los Angeles anymore, and that was just really three weeks ago from this perspective. And obviously, being in New York and most of the other coastal cities, I still believe 90% plus of the country has no idea what's going on or doesn't care what's going on a day-to-day basis. And even, I think the stat is about 10% of the people in the US own about 80% of the equities. So I don't think most people have actually been following the gyrations of the market from a day-to-day perspective. I mean, we try to be a little bit sobering when it comes to this, because you take a sector like retail, the apparel retailers here in the US. If you put a 46% tariff on Vietnam, or even a 25% tariff on Vietnam, the apparel retail sector does not exist in the US anymore. It's impossible. I mean, there's 15 million jobs in specialty apparel retail. So I think the administration is extremely understanding of the fact that you cannot have 3 to 5 million or 8 million people lose their jobs due to that. So we try to be very cognizant of the fact from a big picture perspective, like a sector like specialty apparel, where they're not just going to put an industry, away or to bed in that sense. That would be the Democrats winning every election probably for the next decade if something like that happens. So when we think about it, and I go back to my gerbil comment, it's more scary now. It does feel like if there is some level of stabilization here, or not too many crazy tweets in a 1 or 2 week perspective, that should provide some level of stabilization for what companies can do in that context. I think to that point, though, the long-term capital investment, that's what's most at risk. So again, that's probably does the U.S. end up from a low growth, high inflation, stagflationary type environment for the long term? It has that impact rates. I think short term growth can hang in there if it's really those long term capital investments and how does that impact things on a go forward basis. But there's so many, I'd say, varying things going on with a lot of confusion everywhere. I mean, even as relates to tariffs, there's a question of like what is included, what isn't included, and that's causing companies, as much agita as anything else as well also too. But short term, it does feel like some of the employment stuff will move the other way, and we'll probably get more firings here. And that's obviously in conjunction with Doge as well. So too, that's not going to be great from a short term economic perspective as well.
Yeah, and so, sorry, I'll go back to you, Afsaneh, but we're sort of assuming that there won't be more changes on tariffs, that maybe the 90 days turns into 180 days, maybe the 180 days turns into a longer thing, and perhaps as important, there will be sectoral exclusions, as we've seen over the weekend with smartphones and so on. There need to be a lot of exclusions if the overall rate of tariffs is to go down. Afsaneh, you were going to.
No, I think, I think what Lee said, what you said, and what John said, I was just trying to make sense of the fact that everyone is saying, I think we're all saying that for manufacturing to move to the US, you need a lot of things, but you need regulation to be changed, you need permitting laws to be changed, you need a certainty on rules not changing around you. It seems to me like, what John said earlier, but Europe is the center for regulation. We also, have had a lot of regulation, but I haven't seen over the last few months that changing fast. Or permitting was a very big issue for particularly the energy sector, both energy innovation and all forms of energy, but that has not changed yet. So, or Lee, what you were saying about pharmaceuticals, I was in a meeting with a number of CEOs, and the CEO of one of the biggest pharmaceuticals said, as you said, 5 years before we can move somewhere. And by the way, it's not going to be a lot of employments generated, a lot of, it's going to be a lot of robots and a lot of machines and AI. So it doesn't necessarily create a lot of jobs if we were to move back to the States. So given those long leads and the uncertainty, Lee, what does it take for the industries that you're investing in to actually invest, not to just make the big announcements that we will invest over the next 10 years, billions of dollars, but actually put money to work?
Well, I think pharma is an interesting one because that one, it's, I think, less the investment itself and the employment is what they're looking at, but more of sort of certainly what we saw during COVID of, whether it's China or India control the API or the active ingredient that goes into it. And in a, God forbid, a war with China where they just cut off our access to, certain medicines, et cetera. And that's why as well, when we look at this, it feels like we're moving more into this sphere of influence world than anything else. And that's why, as we've kind of thought about it, as I think maybe earlier people were more worried about Canada and Mexico, we do believe from a US perspective, Canada and Mexico will be a big winner from this. And even again, if you're not moving production into, Arkansas, but you're moving into Mexico, we think that will satisfy for what he's trying to do from a safety perspective of getting more production, back to our general area. And similarly, I mentioned Japan as well. So too, India is a real cog in this as well also, where it does feel like, given particularly Trump's relationship with Modi, India will be a key where, again, he's thinking about this, or we believe the administration's thinking about this in these spheres of influence, where if we can bring production into that general context where we have, out of China, where I think there's more worry from a geopolitical perspective, even as you saw China today, cutting off, or telling people stop buying from Boeing, et cetera. I think there's the, can you bring to this sphere where if there's a protected set of allies where there can be production, the complicated piece for that then becomes obviously what happens with Ireland, because, Ireland as a country really exists as a function of IP, both from technology and from pharmaceuticals, and there's not much else that actually happens in that country. So this is what gets into the trouble of thinking about the policies from purely individual policies to then these broader, and I think to all of your question about what's the end game with all of these things, I think in pharmaceuticals, the end game is to actually bring production back to the sphere of influence to make sure that we're always protected from supply from a pharma perspective. So that one, we do feel like companies are a little bit more focused. And even you've heard, we were, I'd say, excited with the fact that when they talked about the pharma tariffs, they were not done under the IEEPA tariffs. They've done under the 232, which includes, the 207-day process with, the public commentary as well also too, because you've already seen whether it's the J&Js of the world talking about just bringing investment. It's sort of what NVIDIA has done as well also too. I think the promise of investment is just as good as actually bringing the investment here. So I think in pharma, we're a little bit more, sanguine about it, because we do feel like that's more of a protectionist view to protect the supply, and just the promise of investment will be one where we feel like that's a sector that he's already talked about trying to lower drug prices, and having a 25% tariff on every pharmaceutical is not a way to lower drug prices. So that's one where it actually makes sense to us. But generally what we've tried to do on an investment side, I use pharma as an example, is look for industries where either credit prices or equity prices are down, where we don't think there's tariff or big risks, or prices where they have held in and we think there's actually more risk than there's not. So we're trying to look for either what the baby's been thrown out with the bathwater that is not impacted, or stuff that has not been impacted but has big risk going forward, is how we tried to kind of split it up. Where pharma, I'd say we're somewhat a little bit more optimistic of what ultimately the end goals are, either lowering drug prices and protecting supply, which we think can be included in both of those situations. And same thing, they know you can't not have pharmaceuticals come into the country for 5 years while we're waiting for production to be built. So I think they understand that. And that's, again, I know some people question the logic sometimes of the administration, but we think logically that's something that they understand cannot happen overnight from that sense.
So I'm interested in a little bit what you were describing at the beginning was very similar to the Biden policy. Let's have friend-shoring, even if it's not near-shoring. Let's think about India, for example, although, and that is at cross purposes with the notion of reciprocity, since India actually has quite high tariffs and is quite protectionist against the United States. Maybe that will change. So I think some of the uncertainty is really around the goal setting, as John said, and who is, we know ultimately the president is going to decide, but what is driving his motivation when he's making decisions about which tariffs, which countries are subject to tariffs, which sectors are subject to tariffs. But I think it just useful in a way to say that, to kind of level set at the beginning of all of this, say 6 months ago or something, European tariffs on the United States averaged less than 3%. I think many people in America think that it was way higher than that.
But there were none.
Well, you have to, I guess it's how you treat the VAT as well, also too, which is what they would say. So, which is really just this local sales tax. No, I totally get it. But I'm just playing the foil for you. So.
But Caroline, we also have non-tariff barriers, right? Where it's hard to get things in or out. I think Europe also has non-tariff barriers, which we haven't even talked about.
Yeah, that's true. I think the interesting thing about Europe is on the goods, that their tariffs against the United States were actually quite low. They had higher tariffs on automobiles, and that's a very complicated sector. But the point that John made, we're in balance with Europe if we take into account services. And I guess looking forward to the long term, part of US exceptionalism was and has been innovation, and innovation in services, digital services, AI, other areas, even
Health.
he not producing the drugs, but conceptualizing them, doing research. So I wonder how much an attack on that, which wouldn't be felt very immediately, perhaps, but may play out over time, will affect the US as a place to invest and grow, or is this something that will kind of fade away? Certainly, everybody went into the administration, into this year, I think, thinking there would be more of, a logical, something that one could understand. Yes, we're putting taxes, import taxes, tariffs on this country or this sector because for this or that reason, but the reasoning doesn't seem to have been laid out.
I think Carolyn, to your point, I think, or as you would say in the UK, Europe's in a bit of a pickle right now. I think a couple of things. It feels like with Europe, it's less the actual, back and forth on the tariff side. It's more about what have they been spending on security, and obviously, no matter what Germany, tries to re-securitize or reinvest in security, I mean, one way or the other, Europe will need to rely on the US for probably the next decade, as we talk about it, for providing security. And then, we talk a lot about services, and I think that's a very dangerous game for Europe, because I think outside of what the largest tech business in Europe is SAP, other than that, I think the 10 largest are the US-based tech businesses. It's not like there's an alternative where, if Microsoft, if they start tariffing Microsoft 50% for services, like it's not like there's a alternative for Microsoft running computers in Europe specifically, comparing that to China. And I think, taking this a little bit roundabout, I think what they view with China specifically with trade is that, China's been trying to get around a lot of, they've just been moving manufacturing. That Chinese company moves manufacturing to Vietnam, et cetera, to get around the tariffs to do that, or they open the plant in Mexico to get around the tariffs. I think Europe's a slightly more complicated situation, and that one is more, it feels like the administration picking on them as it relates to more investment on the security side, and then potentially buying more energy from the US as well also too. So I think I think the actual pure trade, as you're talking about, because as you know, most of the US auto manufacturers literally paid billions of dollars to exit the European market. So it's not like we want to enter back in. And then from a food perspective, if I was in Europe, I wouldn't want to buy any produce from the US either. I feel like the produce in Europe is so much better as well also too. So Europe's in a little bit of a pickle, because it does feel like it's less related to purely the trade piece and more about, their investment on the security side, and then other things that they're potentially doing, which is really where with them, it feels like the administration is just poking at Europe as opposed to having a pure plan from that sense, where at least with China, it seems like they're really trying to isolate China. And that's why, as I mentioned, I'd say bigger picture, maybe outside of the Europe comment as well. So too, thinking about this from a playbook, because once we get the first trade deal, I think that will tell us in the market a lot more about what the actual priorities are from that sense. I would love to see the first trade deal actually be Vietnam, because Vietnam is the one where that could really be a toss-up whether Vietnam chooses to go more in the China camp or the US camp. So that'll tell you a lot about the priorities that we have. But I think that's why when we think about these things, and it feels like the market does come down, is if forget about getting every trade deal. If you get one trade deal, I think that will unleash a lot of what they're trying to attack and go after with these. But certainly Europe is the one that feels like for us will go on for an extended period of time, because it doesn't seem like, to your point, that there's any pure solutions, because it's a little bit more of this amorphous, like we don't know what it is outside of them investing more on the security side in Europe specifically.
I was going to ask you all, sorry, John, go ahead, please.
Yeah, I just wanted to add, well, what I was going to say is that maybe worth stepping back here for a minute and coming back to the idea of US exceptionalism. What was the bedrock of that view?
Open
And
trade.
Beg pardon?
Openness and competitiveness.
Yes, for sure. But beyond that, or in addition to that, I would say there were two special sauces of the moment. And one was immigration. That as opposed to essentially every other advanced economy, we were getting stronger growth in labor force than had been anticipated because of immigration. So if we're turning that around, then that's a mark against U.S. exceptionalism. Secondly, the area of technology, of tech innovation and growth, and what the optimism about U.S. exceptionalism was that we were on the cusp of some really massive investments, right, in new technology and the possibilities. People say AI, but I heard Jensen Huang speak about a year ago, and then my takeaway was he says in 10 years computers are going to be 1,000,000 times more powerful than they are today. And essentially, what we should look forward to, computers are going to be very expensive, but the marginal cost of computing will be zero. And that there are just huge possibilities beyond just large language models, but all kinds of stuff. Now, so the one question is, or the broad question, are we going to endanger all of the gooses that laid the golden eggs? The openness, as you described, and the sources of innovation, immigration that produced labor force growth, and finally, are we going to mess up the outlook, destabilize the outlook enough to make it difficult for people to think, for investors to think about the massive investments that the new age technology, if you will, is going to require? So it strikes me, these are all up in the air. And it was saying, obviously, not just on trade. I think there'll be a big premium on greater clarity about what the administration really intends to do in all these areas that they seem to have taken such unexpectedly strong action.
John, I was going to add the rule of law also, which
Indeed.
you have done a lot of work on that in your
Indeed.
first life and current life, but it's related to everything else you said. So with all the things that everyone has been saying, I think I'm curious to know, are there any beneficiaries? Is there any country or any sector or any area that you think will emerge from this? As we all have to be, if you're a pension fund, if you're an endowment, if you're a foundation, you have to be fully invested. At the same time as you're coming under a lot of stress, right? So if your assumptions were a certain rate of return, the next 10 years were going to be different than the last 10 years, regardless of any change. But now this uncertainty that we are living under changes a lot of things. It used to be, like John, you said, US exceptionalism, and almost 100% of capital is coming over. I'm exaggerating here, obviously, but a large proportion of capital, private and public markets, was coming into the US equity markets, bond markets, private markets. So what we're hearing is a lot of the big sovereign funds, for example, it's not like they're not buying into US still, but becoming more selective. So like you said, if there's new AI investments, yes, of course, they would be invested. If there are certain interesting areas, but where it comes to where there is an alternative, people are starting to look at Europe. I mean, we have all seen European markets, obviously on the equity side, do better than US markets this year, even before the last few weeks. But that sort of trend of what will happen to the US dollar, what will happen to US equities versus particularly Europe, or certain areas like in Northern Europe, or countries like small, tiny economies like a Singapore, or bigger economies like India, as you all pointed to, I think will be super interesting in terms of looking at the future. But certainly what we're seeing right now at RockCreek is people starting to think in a more diversified portfolio. and
Right.
diversified not just in terms of correlated assets, but truly geographic sector, different kinds of risks, like, which companies will be faster to take advantage of AI versus not. So those are all big questions that people were a little bit sleepy about the last 5-10 years, where there was sort of an assumption on markets. So I don't know if you agree with that, or you see it differently, or what areas you see are better opportunities.
Yeah, I mean, maybe I could start. I mean, just what we're seeing from flows for our investors, both in the U.S. and a lot of people on the credit side. I mean, listen, I think in higher rates for longer, there's been a lot of money that's been waiting for a pullback on the credit side. So we've actually seen just inflows in the last couple of weeks, from whether it's sovereign wealth funds, pension funds here in the U.S. I think there's still money coming in, and I think excitement, especially for credit relative to equity returns still. It's interesting because we've actually, and I was at an event about a week and a half ago with the head of equity capital markets at a large bank, and they had, I'd say, 20 companies, 20 either private equity or venture-backed businesses that were about to go public. And obviously all that is not going to happen at this point in time. So we've started to talk about even, more private investment that could unleash return of capital to LPs on the private equity side as well. So I think there's been more things to do even in private credit in the last 10 days. And same thing, I'd say generally, volatility usually brings out more sellers of assets than buyers of assets. So, we've been able to work pretty quickly to put some really interesting, private credit investments together for, I'd say, domestically focused businesses, either in Europe or in the US, which should be unimpacted by tariffs broadly. Obviously everything's impacted by GDP and what happens on the economic side. So I'd say the volatility equity markets has brought some more opportunity on the private market side, which had gotten very tight versus recently. And I'd say this will bring probably even more pressure for private equity, because this was supposed to be the year that I think a lot of private equity businesses were supposed to be exited and capital returned back to LPs. So it does feel like on that side, it will be even more pressure on the private equity funds who have been having trouble raising new funds to actually exit situations as well. So too, and we think that will be able to be taken advantage of on the credit side as well, also from that sense. But bigger picture, to your point, we do think, as I mentioned, we've been much more optimistic on, Mexico and Canada here in the US. And then as it relates to, I'd say, distribution facilities here in the US, whether it's on the warehouse side, et cetera, because just more goods moving around internally in the US, we think will be interesting on a long-term perspective. And then, we were discussing something obviously right before we got on, but, I'd say domestically focused European businesses, we think are very interesting, because again, if you could do the same lending as you were 200 basis points wider and nothing necessarily has changed, have no US exposure, that's definitely very interesting in the short term as well also. And just bigger picture, I know I mentioned sort of Europe's in a bit of a pickle. I mean, this administration might be the best thing that's happened to Europe in 20 years, because if you have massive infrastructure spending from Germany, you get world slowdown, lower energy prices as well also too, and this forces Europe to deregulate to some extent. I mean, we're actually somewhat optimistic about what can be done on the investment side in Europe, because I mean, this Trump ultimately could be the best thing that happened to Europe to more just kind of get their act together as well also too. So we, in the last 3 months, again, sort of outside of what happened in the last 2 weeks, we've been very focused on finding things to do on the European side as well also too in the recent period as well.
Yeah, and I think that's interesting. Europe is obviously, I think, also feeling with the shock about its US friend sort of punching it in the face. Is also, that is definitely something that has spurred big changes, as we've seen politically in Germany, with the Conservatives moving together to get rid of the debt brake that was inhibiting their spending. So never like to be too optimistic about the speed with which Europe moves.
But that spending was bigger than what they did during the pandemic, right? I mean, it's really, I mean, unbelievable the amount of spending they're unleashing there.
Absolutely.
if it actually happens, and if it happens,
correct.
then we'll
The
see.
other thing for Europe is that we talk about the single market, but they really don't have a single market
Exactly.
other than in goods. They don't have a single market in services. They don't have a single market. And I discovered this when my horror when I was working at Google, and they don't have a single market in finance, as we know. So if those overregulated sectors could be changed, that certainly can. The Europeans themselves, Mario Draghi's done a report, Letter and others. So there's certainly, I would agree, scope there. Perhaps it's more complicated for those in Asia, for whom China is a bigger trade.
Well, that's why I mentioned Vietnam, because Vietnam, it's 40% of their goods go to the U.S., 30% goes to China, and they're really at that sort of, that's the one, to me, that's the most interesting short term on what sort of trade deal looks like, because that's the one that could either go one way or the other from going to the China direction or the U.S. direction specifically.
I think underlying all of the concern about tariffs is that it appears that the president, and at least we mentioned Navarro, some of his advisors, but he himself really feels that the world of cooperation has been equivalent to exploitation of the United States. And so when he talks about bringing factories back to the United States, maybe people in the United States don't want to make T-shirts and shoes. And you talked about apparel. I think that was very telling. But how does that message get?
Well, I mean, ultimately, when you look at him, I mean, he's a real estate guy, and having done a lot in real estate, I mean, he likes to make deals, and he wants to look good, no matter what deal he makes, right? So I think you could have a deal that ultimately, us as pundits say is a bad deal, but if it's a win for him relative to where we were yesterday, that's still a win for him. So I think it's, getting deals and saying he can have a win is just as important of maybe bringing manufacturing back in 10 years or something like that. So, going back into the personality of who you're dealing with as well. So too is important to kind of understand. And again, that's why I keep going back to seeing what this first or second trade deal looks like and what he's considering a win and how they publicize that. That's extremely important to then come up with, as we said, of like, nobody knows what the end game is, but that'll give, is he just looking for wins, or is he looking for actual broad change, which is, I think everybody's worried about this broad change, but if he's just looking for wins, then that's a different thing, which it will get the market a bit more comfortable in the short term.
Well, but that depends what you define as a win.
Well, it depends what he defines as a win. I think
a win is an agreement to making T-shirts in East Los Angeles. Maybe that's from a broader point of view, broad economic point of view, not a win for the U.S. economy in the medium term.
But that's what Jamie Dimon said. If
yes.
It costs $2 to make a T-shirt in Vietnam today, and now it costs $3, that's still better than it costing $15 to make it in Los Angeles. So I think that there's ultimately
precisely.
Again just
yeah, exactly. So it's to say the vision of what the goal is so different. And so it'll depend on who's judging whether it's a win or not a win, right? But what we think of, I think what all of us think of as a win, would probably enhance the medium to long term view about the U.S. economy. But that would probably be, we probably would agree that is a trade deal that would, if anything, produce greater confidence about medium-term structure of tariffs, i.e., if it were Secretary Bessent's escalate to de-escalate, would be a whole lot different than if the nature of the deal is to make sure that tariffs are so high that everything made in China can't come here anymore.
Yeah, and that goes to the point, I think, a geopolitical point about, you were suggesting, Lee, that maybe the goal is shifting, the administration's goal, the president's goal towards just having a fight with China. That doesn't fit well. That means that we would need to get rid of an awful lot of very high taxes, the baseline taxes and the tax on steel and aluminum. They're all still out there or happening, and I think that they could be very damaging to growth. let's even assume that those go away, that you have your deal with Vietnam that turns out to be like TPP or something, like the old,
Yeah.
that it's
Which should have happened.
that it's lowering barriers, trade barriers everywhere. But there's still a kind of trade war with China. And obviously that's difficult for China, but it's also expensive and difficult for Americans and American consumers. And I think that the lesson of how painful that can be has not yet been borne out. We've seen market reactions. We've seen this worry about bond markets and the dollar, but we haven't seen anything in the real economy yet that
Except agriculture exporters, right?
yes,
I
that's
think that's real. I think they're
farm
feeling the
exporters.
pain, very real.
The farm exporters are the ones that would feel the pain from being shut out of China, but the American consumers are the ones that would feel the pain of China being shut out from us, which is a bigger pain for us than being shut out of China.
Well, I think that goes into your points, or probably where you want to take us. What does the Fed do, and how is this viewed as short-term inflation and then a reset? I mean, obviously, I'm sure, like many on the call, like my wife ran out last weekend and bought a new laptop from Apple before we thought prices were going up, and then they got excluded. So I think there's definitely been a bit of panic buying in the short term. So again, even as economic indicators come out in the next couple of weeks, I don't think that they're actually going to tell a real story, because people have definitely changed behavior in the short term. But to your overarching point, yes, I mean, this will have either short-term implications, and how does the Fed respond, and that obviously depends on where growth is going. And certainly, as we talked about, or as you were isolated before, in an environment where you have capital outflows and you're running a deficit, like normally in an EM country, you'd hike rates pretty aggressively, which the Fed is probably not going to be doing that. So we're going to get some sort of form of rate cuts along with QE, and obviously the Treasury has a lot of things they can do to bring rates down as well also. So it's really about, what's the point of view on extended definition of inflation and how's that impacting things. But it's all pulled together, but it's a little complicated. And again, still being, I guess, 8 days into this, it's a little hard to kind of say what's actually going to happen from that perspective.
So John, interest rates going up, down, or staying where they are?
Yes. The answer is yes. But again, I think part of the problem is, I'm just coming back, and this may seem like a cop-out, that the fundamental goals here are still so uncertain that it's hard to know. You could imagine a set of outcomes, as Lee was suggesting, a very favorable trade deal with e.g. Japan or Vietnam, and all of a sudden people are going to be much more optimistic about the outlook, and have a big potentially impact on this run up in inflation expectations, et cetera, that would I suspect encourage the Fed to sit tight, and I would imagine that would be their preference for quite some time, unless they're forced off their perch.
Well, that was the interesting thing from the University of Michigan survey, though, is I think the 2-year inflation expectations went up, but the 5-year inflation expectations actually went down. So it's again, does the Fed look at this as a short-term blip, because then that they react to that differently versus having a core long-term accelerated inflation number as well too.
They do. They have had a recent experience of making a mistake of trying to look
Yes.
at which has to be weighing on their mind.
Yes.
Well, Powell doesn't have to worry about keeping his job anymore, so now he can do what he thinks he wants to do potentially, but not saying that's publicized at all or politicized, but now he can do what he thinks is potentially right, because he knows that he's not going to have this job in a year's time from now anyways.
Yeah.
Can go with his principles. Caroline, what do you think on bond markets, US dollar, and equity markets?
I think we're in a more dangerous mode now on those than we have been. I've always been one, and when you ask us sometimes, Afsaneh, okay, you've got $1, $100, where will you put it? And I've always been one saying, put it in the US. And now I feel uncertain, and that is because of the broader context. And it's Trump won, to some extent Biden, and now, are we in favor of cooperating and working with the rest of the world, which I think is the way to get strong productivity and growth and improve living standards for all Americans, or are we backing away from the world? And I think that the Fed is going to sit on its hands as that becomes clearer. I just want to put one point about what is a good trade deal. For me, a good trade deal is what, I mean, I don't like to quote him, but Elon Musk said, you know, get tariffs down to 0. That helps everybody. But I'm not sure what people generally mean by a good trade deal.
To me, a good trade deal is just one that has, we talk about, just having some sort of clarity, right? Because I think that's what it's basically the system is somewhat stopped now from an investment perspective. So if you get some clarity, again, when we talk about everything, I think with our advisors who we know who've, you know, talked to the administration, the view is, okay, just even if you did a 15% across the board tariff and that was it, like that will give them, people can work with that and you can have clarity about how to invest. So I think just any deal where there's clarity and not the assumption that can be unwound in 12 months or 2 years, I think that's what people want in that sense. So it's again, he could promote it however he wants to promote it, or the administration can promote it however they want to promote it. But ultimately, from a market perspective, it's just having some level of clarity is what a good trade deal would be specifically.
But as sorry, John, go ahead.
Yeah, just like one note that we shouldn't let escape, I think, here, and that is in Asia, where, of course, one of the dynamics have been Vietnam, but the big economies outside of China are first Japan and Korea, who are have been playing a balancing act between China and the U.S. And it will be interesting to see if we force them to rebalance in a different way by our policies, either in a favorable way or an unfavorable way. And of course, Indonesia is interesting as well, but it strikes me that Asia has the possibility, or non-Chinese Asia has the possibility of either creating some real opportunities or the opposite, depending on how we play this. And hopefully, and the idea that we're going to start with Japan hopefully is a positive sign.
I think one of the things for investors is always to look long-term, your best convictions and certainty and rule of law. All of those are kind of very important for investors. And as we've talked about, the big exception about US being also innovation and research. Since all of those are very fluid right now as we speak today, I think the one thing, like I said, that I'm seeing is the fact that people are saying, okay, we don't know where these things will be in a week, in 2 weeks, in 2 years. So I do need to be more diversified than I was yesterday. I need to be a little bit more dynamic in my asset allocation than saying, this is my direction for the next 20 years, 10 years. I need to be listening much more. And I think these kinds of conversations we had today, we should probably have more often, just because things are changing so fast. So I hope that you can all join us so we can continue this conversation together and maybe include some other friends. But let me thank everyone. There's a lot more that we could have said, but we are out of time. And especially grateful to you, John, to you, Caroline, and to you, Lee, for taking part in this conversation today. Thank you.
It's a pleasure.
Thank you.
Thanks.
Cheers.